markets overreacted to that new phraseology about risk management because the Fed has always been a risk manager in both directions. So the bond market probably wanted to hear something more forceful, that this was beyond just risk management, that we are so concerned about the economy that we're going to drive rates even lower. And that could be it. After the press release, we got to 3.99%, and grabbing a 3 handle on the 10-year note probably forced a lot of long players who made some serious money in the bond market to take their profits. So a lot of this is just market positioning. I wouldn't read much more into it than that. We've got to deal with what we know for the here and now, which is that the Fed is back on a rate cutting program. They seem to be at least committed to 2 more cuts at the last 2 meetings of the year. And although the dot plots show that there's still going to be a path towards lower rates, not significantly lower from where we'll be at the end of the year, we'll see what happens in 2026. The Fed is not just a risk manager, but they're also data dependent. So it'll be the data that guides them. I still think what's more important is the destination than necessarily the path towards a destination. Trying to time these things is always difficult, but I think that the key for investors is that the Fed, after a long pause, is back on track cutting rates, and that the trend towards yields out the curve, notwithstanding the backup in the 10-year, I think that downward trend and steeper yield curve in a bull steepening environment is going to remain intact. Yeah, I think that the Fed's telling us that neutral, as far as their estimate's concerned, is 3% on the funds rate. We're still more than 100 basis points above that. But I actually believe that the labor market is going to weaken sufficiently to tip the economy into recession, the recession that everybody missed, including myself, in 2022 and 2023. Because we underestimated the power of the lingering effect of the $2 trillion of cash stimulus from COVID that was still in the system. And that's why we didn't get the recession. So I think that my estimate for the Fed funds rate at the low, it could be 2027 or it could be next year. But in terms of destination, I think we'll get down to 2% on the funds rate in nominal terms, and it'll be 0 in real terms, which, by the way, is where you normally get to at the trough of a Fed easing cycle. When the Fed is in an easing cycle, rates come down across the curve. I know there's a lot of people that are saying that inflation is sticky. There's some people that are saying that as the Fed cuts the short end, then long-term rates will go up. That doesn't happen. Even in the 1970s, 3 recessions that decade, and in the recessions when the Fed was cutting, you wanted to own bonds even though inflation was sticky and we were in a stagflationary environment. So the reason why you want to own bonds is because of the convexity, and as rates come down, you're going to get a very nice price appreciation on your bond, and the total return, I think, will be somewhere around 10% on the 10-year Treasury note. And as the Fed cuts rates, and I think there was a comment before about this, yes, the rest of the world will largely be on hold. The ECB and the Bank of England have already done quite a bit of work, especially the ECB. So as interest rates in the United States come down and converge on the rest of the world, it's going to drag the US dollar down. It's already down 10% so far this year. And I think we're on the cusp of seeing another 10 to 15% decline in the US dollar. Well, what is the best hedge against a declining US dollar? Well, the best hedge out there is gold. So gold's going up for other reasons because it's hit new highs in every currency term. Gold is breaking out yen, sterling, euro, Canadian dollar, New Zealand dollar. That's when you know that gold is trading more as a currency that is no country's liability, as opposed to trading as a commodity. You got to treat gold as money, but money that doesn't pay any interest, which means when interest rates go down, the value of gold goes up. There's other reasons to like gold, but that's one of the principal reasons. Lower rates and a lower dollar is just fuel for the gold trade. So I call the bond bullion barbell. And actually, year to date, that blended return is plus 25%. So it's done even better than the beloved S&P 500, Dow, NASDAQ 100. So what I'm busy doing is trying to devise ways to generate equity-like returns without taking on equity-like risk, especially with these insane multiples we have on our hands right now. The S&P 500 stands out by far as the most overpriced and expensive market on the planet. So for some time, we have been advocating US investors in particular to look at Canada, where up until about 9-12 months ago, the valuation discount was huge, but also Europe, but principally Asia. Asia has been our favorite geographic destination for equity market performance. It's actually done better than the S&P 500 has, although we just focus on the SPX at the expense of everything else. I think that your point's well taken. 38 multiple on the Cape, and that is extreme. In fact, when you're taking a look at valuations and sentiment and market positioning, you're talking about more than a 2 standard deviation event. And when you get to more than a 2 sigma event, that is what a bubble is. And we are in a bubble environment. And as Bob Farrell famously posited, bubbles can last longer than you think, and it's lasting a long time, but they don't ever correct by going sideways. And the old adage that the higher they go, the harder they fall. And I'm not going to say that valuations are a timing tool. They're not. But valuations, and you're right, the Cape is my favorite because it goes back like well over 100 years and it smooths out the cycle. It's a great valuation metric, not from a timing perspective, because investing is never black and white. Investing is always various shades of gray, and you're always playing the probabilities. So do you want to invest with a tailwind at your back or a headwind in your face? And that's what we have on our hands right now. As I said, not a timing tool, but when you're at a 38 multiple on the Cape, your future expected returns are negative. And in fact, we went back in the history books and found that the key threshold is 35. Once you break 35 on the Cape and you look at the 1 year, 3 year, 5 year, and 10-year returns in the S&P 500, they're all negative. It's the only part of the tranches you look at in the Cape where everything winds up negative. So frankly, I like to invest when expected returns are significantly positive, and they're not right now if you're willing to take that 1 to 5 year view. It's not a 1 to 5 month view. This thing could still go even crazier, but it's a massive constraint right now on potential future returns. And there's other markets around the world, like I said before, or you can just invest in sectors, aerospace defense globally. That has visibility. I found that a cheaper way to play the AI trade has been through utilities. I love the Canadian pipelines. Most of all, gold, silver, and the mining stocks have been a great place to be. And I think that will continue. I think we are in a sustained bona fide secular bull market in gold, silver, and the miners. So in this sort of insane environment, which is really more about Mag 7 and the fact we have $9 trillion stocks in the S&P 500 is so incredibly concentrated, I'm shying away from buying indices and focus more on better value across the Pacific, in Asia, and focusing more on sectors as opposed to headline indices. Employment's going down, the unemployment rate's going up. I was surprised that the Bank of Canada stayed on the sidelines as long as it did, because again, I don't look at tariffs as being inflationary, and I look at it as a tax on purchasing power. I find that funny that people talk about tariffs and inflation. Go back to the 1930s with Smoot-Hawley and tell me how much inflation we got from those tariffs. They actually end up being more deflationary. But I think the Bank of Canada has got at least 2 more cuts. I say at least. I think they're going to have to take the policy rate below 2%. The economy is very weak, and what's more important is that the disinflationary output gap, the amount of idle resources in the economy, especially the labor market, is expanding. That puts downward pressure on nominal wages, and that's why there is no inflation in Canada outside of, if you're taking a look at the fact that the CPI includes mortgage interest, which is ridiculous. Can you believe that the StatsCan has mortgage interest costs in the CPI? Did you know that? When you exclude mortgage interest, inflation in Canada is a non-event. It's running like barely at 1.5%. So the bank's got to cut rates, and you're right. Is it the only game in town? Well, right now it's the only game in town. I guess that Mark Carney's doing his best to fast track these natural resource projects, but they're long gestation periods. Like, you're not going to say, oh, I'm going to remedy the negative vagaries of the business cycle through fast tracking natural resources. That's something that is going to help us, hopefully, with our long-term growth potential. We're talking about the here and now. And I'll tell you, the biggest crime that was committed, and it's a crime that continues to go unpunished, is that Donald Trump, after he got elected in 2016, with the help of Congress, cut the top marginal corporate income tax rate in the United States from 35% to 21%. And we just sat here idly by without any response. We are the smaller neighbor, and we have to have competitive tax rates in this country. Until December 2017, we were competitive. So now, with the provincial abatements, the top corporate rate in Canada is like 26%. In the United States is 21%. But you see, in the United States is actually a capitalist country. I don't know what we call Canada. Nobody in the United States had a problem with corporate tax rates going down. Nobody accused the government of being, gifts to the fat cats. They cut corporate tax rates. 2/3 of the employment in the economy come from corporations. But in Canada, the business sector is viewed as something evil. You can't cut business taxes. Where did that come up? So, the thing is that the biggest disappointment isn't necessarily on trade and tariffs. And I think that Mark Carney did the right thing by getting rid of those, countervailing responses that we had. That was definitely not helping out the Bank of Canada's case and only creating more problems for the Canadian private sector. But really, the answer to Canada's fiscal challenges was to reduce the low end of the personal tax rate strata by a full percentage point. Are you kidding me? I was hoping that we were going to see, and maybe it's more a prayer than a hope, because Canada's fiscal balance sheet is much stronger than the US's. I know we always bellyache about, we're going to get the budget coming out in November and everybody's belly aching about the deficits and debts. Our balance sheet is probably about as good as Germany's. And look what Germany's doing now in fiscal policy, and especially in defense and infrastructure. But the thing is that we are not tax competitive. And this is why Canada's economy has been lagging for so long. When you look at the balance of payments data, this is shocking that in each of the past 10 years, Canada has suffered net direct investment outflows. This isn't paper, this is bricks and mortar investment. 10 years of negative direct investment outflow. And you know what? That is costing the economy a full % of GDP growth each and every year. And you know what? The only person talking about it has been me. But I sort of sometimes get tired of reading my own research. I wouldn't mind reading this from somebody else. But that is one of the dead weight drags on the Canadian economy, is our decision deliberately, in the name of social policy, I suppose, to maintain an uncompetitive tax structure. Now, we always complain about where personal taxes are vis-a-vis the US. I agree with that too. However, we do have public funded healthcare here. But people can't just pick up and move to the States, especially now. But capital is freely mobile. Capital can move. And capital creates jobs. But the problem is that does not. Look, we just elected a left-leaning liberal government after 10 years of incompetence. Canadians voted them back in. So it comes to the nature of the fact that you can never campaign on lower corporate tax rates in this country. You'll be impaled because it's a tax cut to fat cats, the business sector. Never mind that the business sector employs 2/3 of the people in this country. But that's really what's needed. We need massive pro-growth tax reform.